Real estate market tips. If you believe the real estate market is collapsing, there are a few things you can do to protect yourself and potentially even benefit from the situation. Here are some steps you can take. Don't panic. The first thing to do is to remain calm and avoid making hasty decisions based on fear or speculation. Real estate markets are cyclical and go through ups and downs. While there may be short-term fluctuations, the long-term trend of real estate values is typically positive. When it comes to dealing with any challenging situation, it's important not to panic. Instead, it's best to remain calm and approach the situation with a clear mind. This will help you make better decisions and take actions that are in your best interest. Panic and fear can lead to impulsive actions that may not be well thought out and could end up causing more harm than good. So, take a deep breath, assess the situation, and proceed with a level head. Yes, that's correct. It's important to avoid panicking when the real estate market is going through a downturn. While it's understandable to feel anxious about your investments, making hasty decisions based on fear can often lead to poor outcomes. Instead, it's important to remain calm, gather information, and assess your options before taking any action. By staying level-headed and making informed decisions, you'll be better equipped to navigate any challenges and take advantage of opportunities that may arise in the market. Assess your current position. Evaluate your current real estate holdings and determine their current value and potential for future growth. If you own property that is likely to be negatively affected by the market downturn, such as a highly leveraged investment property, consider taking steps to minimize your exposure. Assessing your current position is an important step in determining how best to respond to a potential real estate market downturn. Here are some factors to consider when evaluating your current position. Your current real estate holdings. Take a close look at the real estate you currently own, including its current value, cash flow, and potential for future appreciation. If you own multiple properties, evaluate each one individually to determine its strengths and weaknesses. Your debt levels. Assess your overall debt levels and your ability to service your debt in a down market. If you have a lot of debt, you may be more vulnerable to a market downturn, particularly if you have high interest loans or are heavily leveraged. Your liquidity. Evaluate your current liquidity and determine whether you have enough cash reserves to weather a market downturn. If you're heavily invested in illiquid assets, such as real estate, it may be more difficult to access cash if you need it. Your investment horizon. Consider your investment horizon and determine whether you have the time and resources to ride out a market downturn. If you're close to retirement or have a short-term investment horizon, you may need to take a more conservative approach to your real estate investments. Your risk tolerance. Evaluate your risk tolerance and determine whether you're comfortable taking on additional risk in a down market. If you're risk-averse, you may need to adjust your investment strategy to minimize your exposure to potential losses. By assessing your current position, you'll be better equipped to determine how best to respond to a potential real estate market downturn. Consider buying opportunities. A market downturn can present opportunities to buy real estate at a discounted price. If you have the financial means and a long-term investment horizon, you may be able to capitalize on the current market conditions and buy property that will appreciate in value over time. If you want more market tips, comment down below. If you believe the real estate market is experiencing a downturn, it may present buying opportunities. Here are some factors to consider when evaluating potential buying opportunities. Market conditions. Evaluate the overall market conditions in the area where you're considering buying. Look at factors such as vacancy rates, rental rates, and property values to determine whether there are opportunities for growth. Property condition. Assess the condition of the property you're considering purchasing. Determine whether it requires significant repairs or renovations and whether those costs can be offset by potential gains in value. Financing. Determine whether you can obtain financing for the property under favorable terms. In a down market, lenders may be more cautious, so be prepared to demonstrate your creditworthiness and financial stability. Investment horizon. Consider your investment horizon and whether you have the time and resources to invest in a property for the long term. Real estate investments typically require a long-term horizon to generate significant returns. Exit strategy. Develop an exit strategy before making a purchase. Determine whether you plan to hold the property long-term or whether you plan to sell it once the market improves. Having a clear plan in place can help you make informed decisions and minimize risk. Diversify your investments. Real estate is just one asset class, and it's important to diversify your investments to reduce risk. Consider investing in other assets, such as stocks, bonds, or alternative investments. Diversifying your investments is an important strategy for reducing risk and maximizing returns. Here are some ways to diversify your real estate investments. Invest in different types of real estate. Consider investing in different types of real estate, such as commercial, residential, or industrial. Each type of property has its own unique risks and potential for returns, so spreading your investments across different types of real estate can help reduce overall risk. Invest in different locations. Invest in properties located in different geographic regions to spread your risk across different markets. This can help mitigate the impact of localized market downturns and take advantage of growth opportunities in other areas. Invest in different stages of development. Consider investing in properties at different stages of development, such as raw land, development projects, or stabilized properties. Each stage of development has its own unique risks and potential for returns, so diversifying across different stages can help balance your portfolio. Invest in real estate funds. Real estate funds provide a way to invest in a diversified portfolio of properties managed by professional investment managers. Real estate funds can invest in different types of properties in geographic regions, providing a convenient way to diversify your investments. Consider other asset classes. Diversify your investments by investing in other asset classes, such as stocks, bonds, or alternative investments. This can help reduce overall risk and provide opportunities for growth. Seek professional advice. If you're uncertain about how to proceed, seek the advice of a professional financial advisor or real estate expert. They can provide insights and recommendations tailored to your specific situation and goals. Seeking professional advice is crucial when making any investment decision, including real estate. Here are some professionals you may want to consult when evaluating your real estate investments. Real estate agent. A reputable real estate agent can provide valuable insights into the local market and help you identify potential investment opportunities. They can also provide guidance on pricing, negotiations, and financing. Real estate attorney. A real estate attorney can help you navigate the legal complexities of real estate transactions, including contract negotiations, title searches, and property transfers. Accountant. An accountant can provide advice on tax implications of real estate investments and help you develop tax-efficient investment strategies. Financial advisor. A financial advisor can provide guidance on how to incorporate real estate into your overall investment portfolio and help you develop a diversified investment strategy. Property manager. If you plan to invest in rental properties, a property manager can provide valuable insights into the local rental market, help you identify potential tenants, and manage day-to-day operations. Remember, professional advice can be expensive, but it can also help you make informed investment decisions and avoid costly mistakes. By seeking the advice of qualified professionals, you can help ensure that your real estate investments are managed effectively and aligned with your overall financial goals. Remember, a market downturn doesn't necessarily mean that the real estate market is collapsing. It's important to stay informed, be patient, and make informed decisions based on your individual circumstances and goals. To learn more about life, business, and technology, subscribe to this channel. See you on our next video.